The Federal Reserve Bank helped to inflate a potential stock market bubble in 2021 thanks to the help of cheap debt and free money that they were pouring into the markets. Now they're worried that they might have made a mistake, which is why they're changing course. And this has investors like you confused because now what do? Do you keep your cash in the bank where now it's being eaten away by inflation? Or do you put your money in the market and then risk your money potentially being sliced in half? What's up everybody, I'm Jasprit Singh, and in 2021, if you had some extra cash laying around and you kept it in the bank, or in this case you could have even kept it under your mattress or put it in a drawer, you would have gotten the same return. But if you kept your cash in savings, in cash, you would have gotten a 0% return on your savings because banks are paying you essentially nothing on your savings in the bank. But the good news is wages did go up in 2021. In 2021, wages went up by 4%, but unfortunately, wages did not keep up with inflation because according to the CPI reports, which we all know are kind of massage numbers, but the CPI numbers said that inflation went up by 7% in 2021. Now, this looks bad, but you have to look at the other asset classes as well, because real estate in 2021 went up by around 19%, while at the same time, the NASDAQ, so these are typically the tech-heavy stocks, the NASDAQ is an index, the NASDAQ went up by around 21% in 2021, and at the same time, the S&P 500, which is an index, a group of the 500 biggest companies in the stock market, the S&P 500 in 2021 went up by 27%. This means if you were like the majority of people and you're not financially educated, you kept your cash in savings, you kept your cash in the bank, you were a loser. Not just to inflation, but to everything else, because now if you want to go out and invest in the S&P 500, well, it is more expensive now than it was a year ago. If you want to go out and buy a home, it is more expensive now than it was a year ago. And if you want to go out and buy groceries, well, it's more expensive now than it was a year ago. And guess what? Your wages are not keeping up. The reason we saw such high inflation, not just in the prices of things, but also in assets, was because of the Federal Reserve Bank. In 2020 and 2021, the Federal Reserve Bank opened up the money printer and they slashed interest rates, which created an influx of more dollars into our economic circulation, which caused more inflation. Inflation is when we have more dollars, which causes the value of each individual dollar that you have, so your savings and your earnings, to go down, which makes the price of everything else, your groceries, your real estate, your stocks, to go up. In the early part of 2021, when people started to get worried about inflation, the Federal Reserve Bank reassured everyone that inflation is just transitory, it's temporary, so you don't have to worry about it. That way they could continue the money printing and continue ramping up inflation. The Fed wanted more inflation. They made that very public. Now, I'm not saying that the Fed wanted more inflation just to make things more dramatic and make things more interesting. That's actually what the Federal Reserve Bank said when they created their monetary policies to have low interest rates and free money flooding the markets. They said that they wanted more inflation. Forbes covered it. The chairman of the Federal Reserve Bank said that their monetary policies had the goal of increasing inflation. That was their goal. Well, in the end of 2021, that's when the Fed started to realize that they were wrong. They saw that inflation was a problem, and they finally admitted that the inflation that we were seeing was not transitory. Up until that point, the Fed somehow thought that it was a good idea to keep ramping up inflation through low interest rates and free money being injected into our markets to help grow the economy. But then they realized that it was too much. Some people have said that this inflation move by the Fed is the worst call in the history of the Federal Reserve Bank, which is saying quite a lot because the Federal Reserve Bank also said that we did not have any sort of housing bubble before the 2008 crash, and they also said that we had no dot-com bubble before the 2000 dot-com bubble bursting. Now here we are in 2022, and we're really starting to pay the price for all of the Fed's monetary policies. We're paying the price for all this inflation. When you go to Chipotle, you got to pay more money for that extra guac, but we're also paying the price in the asset classes because we're seeing a lot of volatility in the stock market. Hedge funds are selling some of their stocks at record speeds, and now you have a lot of people predicting a downturn in the stock market because now the Federal Reserve Bank is going to have to reverse their policies to make up for their mistakes, and so people are worried about what's going to happen in the stock market. Just so we're on the same page, let's go over the Federal Reserve Bank's goals, because the Fed is the secret little entity that has the ability to control your money because they are in charge of our monetary supply. So what the Fed does is they look at our economy, and when the economy is booming, what they do is they want to cool it down. The way they do that is by increasing interest rates, and what that does is it decreases inflation because they want to lower the monetary supply. When we are in a bust, when we are in a recession, then what they want to do is the opposite. That's when they want to cut interest rates, and that in turn increases inflation. So when you have low interest rates like we've been seeing, then more people are likely to go out and borrow money. More people are likely to go out and get a mortgage. More businesses are likely to go out and borrow money because it's cheap. And so when you have these low interest rates, more people are borrowing money. When more people are borrowing money, you have more dollars entering our economy. When you have more dollars entering our economy, you have more dollars floating around, which makes each individual dollar that you have less valuable. That's why your earnings don't stretch as far, your paycheck can't buy you as much, and your savings don't feel as strong because, well, they can't buy you as much. On the flip side, when you're in a booming economy, a fast-growing economy, the Fed wants to make sure that it doesn't get out of hand to prevent bubbles. We all know how well that happens, but they want to prevent these sort of massive bubbles. So what they try to do is when you're in a very fast-growing economy, they try to raise interest rates, which then makes it more expensive for you to borrow money. It makes it more expensive for you to go out and buy a home. It makes it more expensive for businesses to borrow money, which is supposed to help cool down the economy to prevent the economy from overheating, and this will also lower inflation because if less people are now able to borrow money, there's less dollars entering our economy, which means less dollars, less inflation. You really have to be able to understand this if you want to understand why what the Fed is doing right now is so important, because we're in a very strange economy. When the 2008 crash happened, the Fed had the ability to cut interest rates, which helped to increase inflation, which allowed the economy to recover, at least on paper, because we weren't worried about inflation issues before the 2008 crash happened. So the 2008 crash happened, we entered a bust, we entered a recession, and the Fed slashed interest rates, which made it easier for people to borrow money, which made it easier for businesses to borrow money, which allowed them to increase inflation to help get the economy up and running. We're in a very different situation now because we're already fighting high inflation. We already have low interest rates, and now we might be going back into a secondary recession. This is what the Fed is worried about. Our United States economy right now is not growing as fast as the Federal Reserve Bank would like, and it's actually slowing down, which is opposite of what the Fed was hoping for. CNBC reported about how our economy is slowing down, and it's not just the United States. You have world economies like China that are seeing their economy start to slow down. So now, if you are in an environment where the economy is slowing down, you'd like to see lower interest rates. At least the Fed would like to see lower interest rates. That way, you can help grow the economy faster. But the Fed actually wants to raise interest rates because that's the only way that they can fight inflation. See, the issue that the Fed and the economy are facing right now is the Fed's policies over the last couple of years, which included low interest rates and lots of money printing, which contributed to high inflation, is actually pushing us towards another recession. This super high inflation now is stopping people from being able to afford things. So consumer spending is going down, which means businesses are making less money, which means now we're going towards another recession because our economy is slowing down. But at the same time, we have such high inflation that the Fed has no other option except to raise interest rates. And if you remember what I said just a few minutes ago, what does raising interest rates do? Well, it cools down the economy. It slows down the economy. And so if we're already in a slowing economy where the Fed has to slow down the economy even more, well, now that becomes a big issue for the Fed, the economy, and the markets. The dilemma that the Federal Reserve Bank is facing right now is you can't fight a recession created by inflation by creating more inflation, because that is the tool that the Federal Reserve Bank has to fight a recession. Back before the 2008 crash, we weren't worried about inflation. There wasn't an inflation crisis going on. That's why when the bubble burst in 2008, the Federal Reserve Bank had the ability to then lower interest rates, create more inflation, and help spur the economy. Now we're already worried about inflation, and now the Fed is having to fight inflation, which is going to cause the economy to slow down even more, which would then create even more economic slowdowns. This is why you're starting to see a lot more volatility in the stock market, because investors are starting to come to terms with the idea that inflation is, one, not transitory, and the Fed is going to have to do something to fight this inflation. And so now if it becomes more expensive to borrow money, well, you don't want to have your money kept up in a company that isn't making any money, because now these companies that are relying on debt, that are trying to grow quickly without any real profits, are gonna be paying more money in order to grow. I mean, just think about it practically. If you could go out and borrow $10 million and you only have to pay 3% a year on the $10 million, well, if you can take $10 million, put it in your bank account and put it into your business, and you can grow this $10 million by, say, 5%, you just became profitable. All you had to do was grow your money by more than 3% a year, and now you were going to come out profitably. So it wasn't that hard to see growth when money is so cheap. But the problem with this cheap money is then it causes more inflation. It makes the price of everything go up. And so this is why the Fed now wants to raise interest rates, because they want to start fighting inflation, which then means that businesses that want to borrow money are going to have to pay more money. So if you cannot sustainably grow your business without borrowing super cheap money, well, it's going to become harder and more expensive for you to grow. On the economic side, smaller growth means less employees that are working and smaller profits. On the investing side, that's why you're seeing a lot of investors move their money out of the fast growth and momentum stocks, which are heavily relying on cheap debt, into more companies that have cash, that have profits, that have the ability to grow without the need of super cheap debt. Now, we don't know for sure how much the Federal Reserve Bank wants to raise interest rates yet. Everybody has a guess. Like Goldman Sachs says that the Federal Reserve Bank wants to raise interest rates 4 times in 2022, but nobody really knows. It's going to be up to the Fed, and it's going to be dependent on what inflation looks like in 2022. Because in 2021, the Fed kept saying that the only reason why we're seeing inflation is due to supply chain issues. This pandemic screwed up the supply chain. You have people that are not working overseas. You have all the shipping issues. And because of that, that's why prices of things are going up. Now the Federal Reserve Bank is admitting that it's not just because of supply chain issues, it's also because of all the money printing. And because of that, we're going to see real inflation. But they're also saying that they believe, the Federal Reserve Bank believes, that inflation will cool down by the end of 2022. The Fed believes that inflation will come down to 2% by the end of 2022. Remember, inflation was 7% in 2021, and they believe it's going to come back down to 2% by the end of 2022. Now, if the Fed is wrong, I'm going to say that one more time. If the Fed is wrong, then they're going to reassess their monetary policy, which means they're going to hike up interest rates even more. If that happens, then it might be a shocker to some investors or to the markets, because the people that are trusting the Federal Reserve Bank are hoping that they will not have to do that. But if they have to do that, well, then that means borrowing money will then become more expensive, and that would then slow down the economy even more. Now, to be fair, you do have some people and economists that are of the belief that raising interest rates will not slow down the economy, that we have an economy right now that is so robust, that is so strong, that raising interest rates can't slow it down. Now, my job here as a random guy on YouTube is not to get you to like me or to tell you what to believe. It's to educate you. That way you can make smarter decisions with your money. So let me just diagram this out. That way you can understand and make the decision for yourself as to how rising interest rates would affect the economy. Let's assume that you want to go out and buy this home, and in order to do that, you would have to borrow $400,000. Well, if you could go out and borrow $400,000 and get a mortgage at 3%, it's going to cost you just a little bit under $1,700. If I can get my numbers right, you have $1,700. But if you had to pay 6% in interest on the same $400,000, now this exact same amount of money and home is going to cost you $2,400 a month. So it's going to cost you significantly more just because mortgage rates are higher. So when interest rates go up, it becomes more expensive to borrow money. Now, what do you think is going to happen? Do you think more people are going to go out and buy this home when it's more expensive, or are more people going to go out and buy it when it's cheaper? I mean, you can even think about how it works at your local mall. Do more people go shopping when things are on sale, when they're cheaper, or do more people go shopping when things are more expensive? Most of the time, people are going to spend more money when it's cheaper, because it's cheaper for you to go out and buy more things. Well, when things become more expensive, people can't spend as much and they don't buy as much. When people don't buy as much, the economy slows down because the economy relies on spending. The more money you spend, the more money somebody else makes. If you don't spend any money, then how is Chipotle gonna make any money? If you don't go out and buy Apple AirPods, how is Apple gonna make any money? If Apple isn't making any money, the corporation, well then their profits are less. If their profits are less, then their stock isn't as valuable. If the stock isn't as valuable, then people don't want to pay as much money for the stock, which in turn pulls the stock price down. So does this mean that we are going to see a stock market crash in the near future? Well, it really just depends on how fast the Federal Reserve Bank has to raise interest rates. If the Fed starts to realize even more that this inflation is not transitory, that they need to do more things to cool this inflation down, then they will be forced to raise interest rates even faster. If they're forced to raise interest rates faster than expected, that will slow down the economy more than expected. If it slows down the economy more than expected and people spend less money than expected, well then that would hurt the economy even more, which would in turn hurt the stock market even more. But of course, it isn't always so simple. I mean, you can't just look at interest rates as the sole factor to understand what's going to happen in the stock market. The stock market has a lot more factors influencing it than just interest rates. If the economists who say that raising interest rates will not slow down the economy are right, then it won't be as bad. Because yeah, we're raising interest rates, which will help cool down inflation, but at the same time, the economy doesn't slow down, which means companies continue to make record-breaking profits, then it's not so big of a deal. Because yeah, it's becoming more expensive to borrow money, it's becoming more expensive for businesses to borrow money, but the economy isn't slowing down, which means companies continue to make profits, which means people still have money to invest, which means people will continue to put their money into the market because they like the valuations of companies, which would continue to push the stock market up. And then of course you have something that I like to call the X factor, which are the government programs which are really unpredictable. Now, if you would have asked me this 15 years ago, this would have been something that very few people would be predicting, but after what we saw happen in the 2020 pandemic, where the government created eviction moratoriums, where the government created foreclosure moratoriums, where the Federal Reserve Bank opened up the money printer and started unlimited quantitative easing, which means they opened up the money printer and said that they would put an unlimited amount of money into the markets to make investors confident to invest their money back into the stock market. That makes it a little bit harder to predict what's going to happen because the Federal Reserve Bank clearly does not want to see another stock market crash, which is why they created more inflation just to inflate the stock market. For the last number of months, they've been putting billions, hundreds of billions of dollars into the stock market, into the bond market, just to make investors confident to put their own money back into the markets. So the Federal Reserve Bank is willing to sacrifice the financial health for the average American just so investors can continue making profits. This is why it gets kind of hard to predict what's going to actually happen in the market, but our economy does have some red flags, especially as to what's coming, which is why I want to go over what I'm doing with my money right now. But before I get into that, two brief things. First, a quick disclaimer. You are never guaranteed to make money when you invest. You might even lose money, so always do your own due diligence and never blindly listen to a random guy on YouTube. And if you're looking for some extra coaching or guidance when it comes to investing your money, you can check out our Market Insiders program. Market Insiders is a financial education subscription service where every week you get access to a group coaching call, a stock market coach, a real estate coach, and a real estate investing coach. And every week you will be able to watch our coaching classes from stock market, real estate, and cryptocurrency. You get to learn about what's going on in the markets, and you get to learn from the experiences of these investors, and you get to learn from their failures. It is an amazing program. We have amazing coaches, and you can try it out for free because we have a 10-day free trial. And during those 10 days, you can go through the entire app. You can go through the entire program. You can go through the coaching classes. You can watch the previous recordings. You can go through the other classes that we have and learn. And if you like it, you can continue with it. If you don't like it, well, it's not going to cost you a penny as long as you cancel within that free trial. So if you want to learn more and sign up for Market Insiders, I'll put the link to where you can do that in the description below. I don't like the idea of just trying to time the market, because what happens when an investor tries to time the market is when things are going down, you just keep saying, I'll wait until it goes a little bit lower. If it goes down 10 more percent, then I'll come in and buy. And what ends up happening for a lot of investors is you miss the bottom. You say, oh, it's going to go down a little bit more, then it starts to go up. And then when it starts to go up, you say, oh, this is just a little bounce. I want it to go back down lower. That's when I want to buy because now it's too expensive. And then it goes up even more. And now you say, oh man, I missed the bottom. Now it's too late for me to buy. It's too high. And then it goes up even more. And you say, well, that's it. I guess I'm not buying. And then when it comes time for you to sell, it's the same thing. You get greedy. You want to time the top and then you say, I'll sell it when it goes up just another 8%. And then it goes up 2 more percent and you're like, just a little bit more. And then it starts to go down and you're like, oh, it's just a little bit of a dip. It's going to turn back up. And then it goes down more. And you say, now I got to wait. I used to have big profits. I can't sell it for a small profit. And then it goes down more and now you're at a loss. And now you don't know what to do. And then it goes down even more. And now you're at a big loss. Now you start to panic. You feel bad. You had this big profit. And now you're selling at a big loss. Instead of trying to time the market like that, I have 2 different strategies. A passive strategy and an active strategy. My passive strategy is super simple. All I do is I have some ETFs that I want to own. These ETFs give me exposure to a few different things. I have some ETFs that give me exposure to the general stock market, the S&P 500. I have some ETFs that give me exposure to innovation and some of these growth companies. So it's a different sector, a different area of the stock market. And then I have some ETFs that give me exposure to emerging markets, kind of as my protection. So these are stocks outside of the United States. So every week I have money going into these ETFs, and this happens passively and automatically. I don't know if you can read this or not. And this will continue to happen every single week, no matter what's happening in the market, whether the market is up or down. So this is giving me exposure to the market, no matter what, and it's happening every single week. Then I have an active strategy where now I know some individual companies that I want to own. But I want to make sure that I'm coming in at a good price, that I'm not overpaying for them. So these are the companies that I'm watching. These are the companies that I'm studying. These are the companies that I'm reading the earnings calls. And when I see the price of these companies go down, that's when I come in and buy. And if they continue to go down, then I buy even more aggressively. And so as it comes down, that's when I buy. The further down it goes, the more aggressively I buy. If it doesn't come down, I don't buy. This is one of those things where I just want to make sure I have a good price. I don't want to come in and chase a stock. I don't want to come in and chase a company. I want to buy something that I believe is a good value. Now, what's a good value to me might not be a good value to you. This is why I don't give stock picks, because what's good for me might not be good for you. And what's good for my time horizon might not be your time horizon. Maybe you're buying for 6 months. Maybe you're buying for 2 years. I don't know. Depending on that, what investments you're investing in are going to be different than me, and my goals are going to be different than your goals. The things that you invest in are going to be different than the things that I invest in, and your risk tolerance is going to be different than mine. But what I'm trying to do here is, instead of trying to time the market, is I want to know what I buy, and if it comes down, that's when I buy. If it goes down more, that's when I buy even more aggressively. You have to pay attention to what's happening around you, and I hate the idea of trying to predict what's going to happen. Maybe the stock market will boom. Maybe the stock market will crash. Maybe the stock market will go sideways. I don't know. And I'm not going to wait to do anything until that happens, which is why I have a strategy. I know that every week some of my money is going to be invested, and I know if the stock market goes down and I see a good buying opportunity, I'll come in and buy. This is why a lot of wealthy people don't get worried about a stock market crash. They treat it like an opportunity to go in and buy, like Black Friday, because that's when investments go on sale. They're on discount. What's up, everybody? If you want to continue building your financial education, I linked a relevant video here that I think you'll love, and as an added bonus, I have a free guide on how you can start generating passive income that you can download and read for free. All you gotta do is click that button below. The economy was going down like this, but the stock market was going up like this. This was through the help of the Federal Reserve Bank